Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 196 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, we are going to begin our week-long conversation on index funds. And specifically today, we're going to be talking about where index funds came from and talking about one of the originators of index funds and some of the wisdom that he left behind for us, okay? So we're really going to dig into that because I really think that index funds are some of the most fundamental and useful investment products for the masses. And so I think it's important that we understand them and really understand all of the positives, all the drawbacks, all of the little minutia around them throughout the course of this week. But like I said, today we are going to start with talking about the creator of index funds, Jack Bogle. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, and be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to create a financial plan that is specific to you and your family's needs and keep you accountable to that plan over the long term, then I can help you do that. Just go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. So a great place to start this week, if we're going to spend all week talking about index funds and index investing, is to really nail down what index investing is. Okay, so index investing in its simplicity, right, is utilizing a passive investment strategy that requires a manager to only ensure that a fund's holdings match those of a benchmark index. Okay, so with index investing, all that's going on is that some fund manager is saying, let me do exactly what an index does. Let me invest exactly like an index invests. The manager is not choosing anything by their own discretion. They're not doing any research and trying to figure out if one thing is better than another, one stock's better than another, a bond's better than another. They're not trying to do any of that. What they are trying to do is simply say, what is this index doing? And let me set up my portfolio with the exact same weights into the exact same investments as this particular index, whatever index it is that they are trying to track, right? One of the most common indexes that we try to track and that I reference quite a bit on this show is the S&P 500 index. And that's just because that is one of the most commonly used benchmarks for the American stock market. And so if you buy an S&P 500 index fund, you are literally buying a mutual fund that will track the S&P 500 exactly. It will literally do what the S&P 500 does. So index investing is very, very simple, right? It doesn't require a whole lot of work. Typically, index funds are cheap as far as costs to investors, and they are widely available. They're widely available in the form of mutual funds and ETFs. A lot of people have taken advantage of the availability of ETFs in the market to invest in different indexes. And so that can be a way that you do that as well. But they were initially created in the form of mutual funds that just tracked an index. And the creator of the index fund, the individual who had the idea and put it into play for the index fund, was Jack Bogle, otherwise known as Jack Bogle. And Jack Bogle, he was the founder of the Vanguard Group. And for those of you who don't know what the Vanguard Group is, just go online and type in Vanguard, right? And they're one of the largest investment companies in the world today, one of the largest mutual fund providers, and have more assets under management than just about anybody out there. They run right alongside the Fidelities and the Schwabs and the Merrill Lynches of the world when it comes to asset management. But what they really push is index investing, because that was Jack Bogle's primary objective, was low-cost index investing. Okay, so what I'm going to talk about today, we're going to talk a little bit about what Jack was about, who he was, and then we'll jump right into some investing tips that Jack left behind for us that go right alongside investing in index funds. Okay, So Jack Bogle was the founder of the Vanguard Group and a major proponent of index investing. Bogle revolutionized the mutual fund world by creating index investing, which allowed investors to buy mutual funds that track the broader market. He did this with the overall intent to make investing easier and at a low cost for the average investor. So the fact that transaction costs are almost zero now, the fact that there are several different index funds and mutual funds that have 0% expense ratios, you can thank Jack Bogle for that. He was all about low cost investing for the average individual. Okay. So Bogle introduced the Vanguard 500 fund, which I actually have money in the Vanguard 500 index fund, which tracks the returns of the S&P 500, and he marketed the first index fund to retail investors, which is a really big step in the investing world because, as we even know today, institutions take up a lot of the trading volume. Institutions do a lot of the trading out there and a lot of the investing out there, and if you don't have the right connections or the right amounts of money, then getting your money invested with those institutions may be quite difficult. But to have the retail investor have more power is what Jack was about. And he definitely made it so with the introduction of the index fund. Okay, one of his pioneering achievements was low-cost investing in mutual funds by creating what we now call no-load funds, which means, back in the day before there were just expense ratios, right? Expense ratios being a percentage of assets under management that you must pay annually, that comes out of your account annually because you're invested in some mutual fund or ETF or something of the like, right? Before that was just the case, there were also loads, and a lot of mutual funds still have loads today, but the vast majority are no load funds because of the pioneering work of Jack Bogle. And a load was either on the front end or the back end, and it was some amount that you had to pay either at the buy or at the sell or both of the mutual fund that you were purchasing. And he said, let's just get rid of that. Let's make investing cheaper. Okay. And so he really pioneered a lot of things that we are using today and that we are using in large amounts today. I mean, a couple of years ago, the big talk was, is index investing just getting too huge? Is index investing, just way too large and crazy? And, the story flips a lot of times in markets because today they don't talk as much about index investing and it being some type of issue because so many individuals, so many retail investors have moved into the space of investing in individual stocks on things like Robinhood and investing in a lot of things that they don't understand. But there's still a lot of passively managed money in index funds. And that's something that index funds are well known for, is their passivity, right? They are passive investments by trade because they are not trying to actively beat some index. They are only trying to keep up with exactly what an index does throughout time, which can provide you with very good returns at a very low cost. Okay, so that's what index funds are. That's who Jack Bogle was. That's what he was about. Okay, now something that Jack Bogle had no lack of was wisdom, and he left behind several little bits of wisdom that I think could be really useful for us, and we're going to cover 9 of them today. 9 things that he said that I think you can take with you and really allow you to learn more in your investing journey and maybe apply these specifically to your investing journey. And not only that, he wrote the book, The Little Book of Common Sense Investing. And that book gives you a lot of practical wisdom about investing as well. And I think that book could be really useful for any of you out there who want to read it. It's just a little red book, and it is an amazing read. Okay, so let's start with things that Jack Bogle said, things that he left behind for us that are tips as to how we should go about our investing. He said, first, if you have trouble imagining a 20% loss in the stock market, you shouldn't be in stocks. Okay, and this really speaks to his long-term viewpoint when it came to investing. Okay, he was the ultimate long-term investor, and he was basically saying, hey, the stock market drops from time to time, and we know this. The stock market drops from time to time, and it drops more than 20% from time to time. We just saw it last year, just a little over a year ago. We saw a peak to trough drop of over 30% in the stock market, right? And he's saying if you have trouble imagining that, if you have trouble imagining that the market could drop that low or that it could just drop that fast, then you may not need to be in stocks, right? The recent stock market crash has made it abundantly clear, right? It's important if you're going to invest in stocks to understand that the market drops about 20% or more every few years. And after each such drop, it has always recovered and gone to new highs. That is what's extremely important, is that even when the market drops a lot, it has always recovered, because these things that make it drop very quickly are exogenous events. They are things that are very damaging to the system and big changes in news that the market prices in, and the market tends to overreact in a lot of cases, especially on the back end of a bull market. They'll overreact in a large way. Okay. Now, this sometimes happens within a matter of months, but it might also take years for the market to rebound. That's why you only want to invest in stocks with money you won't need for at least 5 or more years. And that's something that I've taken from Jack Bogle and that I've communicated to you guys time and time again, is that if you need money within 5 years, then do not put that money in the stock market. You should not be investing your emergency fund, because you could need your emergency fund tomorrow, right? You don't know what's going to come around the corner in the short term, and you don't want that money to be invested because the market could drop 20% or more, right? But this brings us right back to a conversation we've had before about bull and bear markets, and how long and how awesome bull markets have been, and how short and really insignificant bear markets have been over the long term. We must remember that the average bull market lasts 4.4 years historically, right, over the last 100 or so years. Here, I think we're looking since 1942. Since 1942, right, the average bull market lasted 4.4 years with an average return of 153.2%, and the average bear market lasting only 11.3 months with the average loss of 32.1%. So the bull markets really outweigh the bear markets. And if you can't imagine the market dropping hard, then you should not be in stocks in the first place. That's something you have to build the gut for and be able to live with, even if you are an index fund investor, because indexes are the things that we watch go down 33% or more last year. They are those benchmarks that we look at and we say, well, the market has dropped 20, 30, however many percent. Okay. So don't be surprised if that's the case. Be ready to buy more, and don't just be ready to jump out at the first sign of panic, because you won't get anywhere investing over the long term if you do that. Okay. So that's his first piece of advice. Second piece of advice from Jack Bogle: owning the stock market over the long term is a winner's game, but attempting to beat the market is a loser's game. Okay, so one of the big things that Jack Bogle preaches, and if you read the little book of Common Sense Investing, something that he talks about time and time and time again, is that mutual fund managers tend to underperform the market over a long period of time. Okay, so consider this. As of the middle of 2019, the S&P 500, right, an index of America's 500 largest companies, outperformed fully 90% of large cap stock funds, right, over the past 15 years, according to the people at Standard & Poor's. Okay, so in other words, only about 10% of the mutual funds run by financial professionals who carefully decide what to buy and sell, and when and who to focus on, large companies, are able to deliver above average returns. This is largely due to the fees that they charge, and it's common for actively managed stock mutual funds to charge around 1% or more annually, while many index funds that track the S&P 500, like I said earlier, may charge less than 0.2% annually. And for many of them, you can find them for almost nothing. Okay, I know the Vanguard 500 fund, I think the expense ratio is 0.04% annually, which is almost nothing. But the whole point here is that the actively managed mutual fund game is not a winner's game, right? Over a 15-year period, and hopefully you're wanting to hold a mutual fund for 15 years or more. Hopefully you're wanting to invest for a long period of time, right? And if you're holding the same mutual fund, the same actively managed mutual fund for 15 years, you have a 90% chance of losing to the index. You have a 90% chance of losing to the market, okay? So yes, if you own the stock market, if you own the index, that is a winner's game. That's something that you can try to do, and something that is very easy to do. It's very easy to own shares of a market index, right? But if you try to beat the market, and especially try to do so via actively managed mutual funds, then that is a loser's game, especially because a lot of money flows to active managers who are winning. And those active managers who are winning then have to take bigger and bigger positions, right? And they can only buy certain amounts of certain companies, right? So they have to be more selective, and they get more conservative over time because they have more people who they are trying to keep as clients and keep bringing in those fees. And therefore, they are not likely, as you can see here, to outperform the market over a long period of time. So own the stock market, but don't try to beat it with actively managed mutual funds. Okay. Third piece of advice: the true investor will do better if he forgets about the stock market and pays attention to his dividend returns and to the operating results of his companies. Okay, so even though Bogle was all for index investing, right, when he was first beginning, index investing was not a thing. Right? So people were having to choose between actively managed mutual funds or buying stocks of their own. Well, one thing that he's talking about here, if you were trying to pick individual stocks, and this is a great piece of advice for those of you out there who may be trying to pick individual stocks to buy, right? Don't worry so much about the market as a whole. Don't pay so much attention to the fluctuations and the variation in the market. Pay attention to the dividend returns that you can receive and the operating results of the companies. Right, the operating results of the companies being their operating incomes, right? And then that trickles down obviously to their earnings and their cash flows and all of these different things that are metrics that tell you how healthy a company is, how healthy a company is going to be in the future, and what types of returns you can expect from that company moving forward, and what percentage the operating income is of revenues, or what percentage net income is of revenues, or free cash flows of revenues, whatever it may be, right? These metrics that help you to determine if a company is financially healthy or not. So a true investor, right, will always do better if we can forget about the market, forget about the fluctuations, forget about the volatility, forget about the charts, forget about the graphs that you see on CNBC every day, and really hone in, pay attention to how the company is distributing capital to investors via these cash distributions in dividends or in the repurchasing of shares, and paying attention to how the company is doing operationally. Are they doing well operationally? That should really drive your investment decisions, and that's where you will be best suited as an investor. Okay. Now, the opposite of doing this, the opposite of honing your attention in this place would be jumping in and out of stocks without ever having a solid understanding of the underlying companies. And as we talked about, I think 2 weeks ago now, is that Peter Lynch, right? Peter Lynch, who's one of the best investors of all time, talks about owning what you know. And Warren Buffett talks about the circle of competence all the time, only investing in the things that you understand, the companies that you understand. And Bogle echoes that here by saying, hey, if you don't understand the companies that you're going about investing in, then you shouldn't invest in them. You shouldn't be jumping in and out based on things that are short term and don't have a lot of staying power. Base your investments on the returns that you can receive from those distributions, those dividends, those share repurchases, and the operating results of the business. Okay. Then, fourth piece of advice that Bogle leaves for us is that buying funds based purely on their past performance is one of the stupidest things an investor can do. And you may say, well, how am I supposed to choose funds then? How am I supposed to choose funds to invest in? Well, Bogle is saying, don't buy actively managed mutual funds, like I was talking about a moment ago, right? He believes, and the data bears out, that actively managed mutual funds just don't work over a long period of time. Okay, so what he's saying is that, yeah, you can buy funds that have beat the market previously, but those funds that have previously beat the market are attracting a lot of money. It's going to be harder for them to beat the market moving forward, and a large percentage of them do not beat the market moving forward. And so what are we trying to do here? Are we trying to keep up with the market, or are we trying to beat it and failing to beat it? Okay, so buying funds based purely on their past performance is a stupid thing. This is a common mistake that the mutual fund investor can make, and stock investors make it too. If you see a mutual fund that soared more than, say, 50% last year, you might jump in wanting to collect a 50% return yourself. Right? Same thing with stock investors. A lot of people over the past year or so have seen the stock market boom, and it's really attracted a lot of retail investors because those investors were like, well, I don't want to miss out, right? It's that FOMO, fear of missing out. They're trying to jump in on these stocks that they don't understand, on these companies that they don't understand just because they've made good returns previously. Well, that does not mean that they're going to continue making great returns. Maybe quite the contrary with individual stocks. You may be looking for quite the pullback from some overreaction to whatever good news that there may have been about the company over the past year, or whatever tailwinds that they may have had that was pushing them forward. Okay, so what you need to do is focus on long-term results and put more weight on what you expect the company or fund to do in the future than what it has done in the past. And you don't even have to worry about that if you are investing in index funds, because index funds, they just follow the index, right? So you don't have to worry about what the fund's going to do in the future or what it's done in the past. It is going to do what the index does, and that's what you should expect. Okay? Then, fifth piece of advice he leaves for us: lower costs are the handmaiden of higher returns. Okay? Now, we all really pay a lot of attention to the charts. We pay a lot of attention to what those gross returns are. And what a gross return is it is just basically what a stock has done or what a mutual fund has done over some period of time. Right? It does not take into account the costs associated with investing, specifically in mutual funds in this place that we're talking about here. Right? So lower costs, right? When you can lower your costs, then you can bring more returns back without having to pay that back to whatever investment company runs that mutual fund or that investment account or whatever it may be. Because if you have two individuals and they both buy S&P 500 index funds, and one is paying, let's say, 0.1% and the other one is paying 0.04, well, the one that's paying 0.04 is going to have higher net returns over the long term than the person paying 0.1. Now, this is a very narrow view, right? Because it's only going to make a lot of difference over large amounts of money. But nonetheless, right, you're investing in the exact same thing. Why wouldn't you want the lowest cost of the exact same thing? And most mutual funds, most actively managed stock mutual funds, right, they invest in things that are very similar to the S&P 500, are very similar to index funds. And if you are trying to pick actively managed mutual funds, which we see is not a good idea here, right? But if you're trying to pick out an actively managed mutual fund and it's not likely to outperform the S&P 500, and you're paying a high percentage in fees, you're paying high costs, then not only are you losing to the S&P 500, you're losing twice, because you're losing based on return and cost, which is putting you even further behind. So let's look at an example. Imagine 3 stock mutual funds. One is an index fund charging an annual fee of 0.1, while the other 2 charge 1% and 1.5%. If the stock market averages 10% growth over a given period, you'll end up with average annual gains of 9.9%, 9%, and 8.5% respectively with those funds. Now, if you invested $10,000 annually, right, your outcomes would be quite a bit different over the long term. Okay, so over a 10-year period, the difference between the 9.9% and the 8.5% is about $14,000. The 9.9%, you're up to $174,000. With the 8.5%, you're up to about $160,000 to $161,000. Okay, but over 20 and 30 years, right, you get to the 30-year number, and now the difference between 9.9% and 8.5% is quite large. Right? Even though you're earning the same gross returns, the costs are simply different. Okay? And those costs being different cost you a lot, because with a 9.9% growth, you would have $1.78 million. But with the 8.5% growth, net growth, right, you would have only $1.35 million. Okay? So this is a difference here. This is a difference of $0.53 million, otherwise known as $530,000. So you're giving up over $500,000 by paying higher fees for the same returns, which is absolutely ludicrous. Now, this is only playing it out 30 years. If you play it out 40 years plus, then this gets even more exacerbated, okay? So lower costs are your friend, and they will lead to higher net returns over the long term, okay? Now, sixth piece of advice that Bogle leaves for us is that the 2 greatest enemies of the equity fund investor are expenses and emotion. So we just talked about expenses, right? Expenses, the higher the expenses, it is going to be more difficult to keep up as far as returns and to build the type of portfolio that you want to build over the long term. But emotions can do you even worse. Because like we said on the outset, if you can't imagine the stock market dropping 20%, if you can't imagine volatility, if you can't imagine variation in stock prices, then why are you in stocks in the first place? Okay? The cost of expenses is clear. Okay, but emotions are another challenge for investors to overcome. So think about the recent big market drop. So think back to last year when the market dropped in a large way. Okay, this tends to lead many people to panic and sell their stocks, which it absolutely did, and that causes stock prices to fall further. Market drops are actually great buying opportunities for investors and are not times that you should be thinking about selling. As Warren Buffett has explained about his own investing style, we simply attempt to be fearful when others are greedy and to be greedy when others are fearful, right? Don't be fearful when others are fearful, because that is not the time. That is not the time that you are going to be able to make better returns or maintain your returns in the way that you think you are. Because the likelihood is you'll sell too late and you'll buy back too late, meaning you'll take some losses and you won't get the returns on the back end. Okay, so don't let your emotions lead to bad investment decisions, especially if you're going to invest in individual stocks. Do not let your emotions take over and make bad decisions in the short term when you can hold on to a stock, because a single stock is going to have a lot more volatility than an index is. So just keep that in mind and keep your emotions in check. And like I've said before, if you're trying to invest in individual stocks and your emotions aren't up to par to keep up with the volatility of individual stocks, then don't invest in them in the first place. But you still have to keep your emotions in check, even if you're investing in funds and investing in index funds and things that are less volatile, yet are still going to have large drops from time to time. Now, the seventh piece of advice that he leaves for us is when there are multiple solutions to a problem, choose the simplest one, right? And that's just the baseline of index investing. He's basically saying, hey, if these other actively managed funds are making about what the index makes, why don't we just take what the index gives us, right? Why don't we just take the 90% chance that we are going to out-return them and be as simple as possible with the index? So be simple with your investing if it can get you to the same place. Because a lot of people try to be very complex, and it only leads them to not making the returns they could have made otherwise. Okay. Then the eighth piece of advice that he leaves us is do not look for the needle in the haystack, just buy the haystack. Okay. Because he talks about index funds being very, very important, index funds being very, very useful. And he's saying you don't have to go about trying to find the best company within the thousands to make decent returns over time. You don't have to try to pick individual companies to make good returns. You can make good returns by simply buying the entire market, right? Buy a broad market index fund, buy the S&P 500 index fund, buy the Vanguard total stock market ETF, right? That's something that a lot of people buy into. And I'm not suggesting that by any means, but that is a very popular ETF that a lot of people use that does track the entire market. And there are plenty of broad market index funds like that. All right. So don't look for the individual needle in the haystack if it's too much work for you, right? And don't try to pick individual stocks that you think can beat the market if it's not the simplest thing to do. The simplest thing to do and the simplest way to make good, solid returns over the long term is to buy the index, and that is what he will continue to preach. Then the last piece of advice, number 9, that he leaves for us is that the winning formula for success in investing is owning the entire stock market through an index fund and then doing nothing. Just stay the course. Too often do we feel like we have to do something in our investing life? Too often do we feel like we have to be active and that we have to be moving things around and making changes? But that's actually what takes away from our returns over the long term, right? What actually keeps our returns and keeps volatility down and maximizes returns over the long term is doing nothing, right? Even if you buy individual stocks, just sitting with those stocks does people a lot more good than a lot of short-term trading and trying to get in and out of things. Just buy something and stick with it. And he specifically talks about buying index funds. And the vast majority of you out there, you should be owning only index funds. Buy the index funds and sit on them. Do not get tricky. Do not get crazy. Early on, it's going to seem like your accounts don't do much because it's not a lot of money. But as your money compounds, your money grows on an exponential curve. Give it time. Let it do what it's supposed to do and make those returns that you can make in the market. And I promise you that over a long period of time, that will be sufficient for you to build some type of wealth that will allow you to live the financial life you've always wanted to live. So even more than my advice, take heed to the advice of John Bogle. And if I ever talk about things that he has said or that he has suggested, listen to him a lot more than you listen to me, because he was far more successful over a long period of time. I'm just a young guy that's relaying the message here, but he really knows what he's talking about and did the most for the retail investor by creating the index fund. But I do want to keep this conversation going, and we will continue to do so over the course of this week with index funds, what they are, their drawbacks, their advantages, and all the different minutiae that we could talk about when it comes to these investment vehicles. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, then be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to create a financial plan that's specific to you and your family's needs and keep you accountable to that plan over the long term, then I can do that. Just go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. So tune in tomorrow as I talk specifically about three of the indexes that we pay a lot of attention to: the Dow, the S&P, and the NASDAQ. So tune in for that, and I think that'll be really enlightening for a lot of you who are learning more about the stock market every single day on this show. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.